About 5 years ago, the Fed launched an unprecedented shopping spree, commonly known as quantitative easing. In plain English, a wild attempt to buy $1.25 trillion in mortgage bonds in 12 months, with the aim to affect credit conditions for households and businesses. It is worth noting that in its almost 100-year history, the Fed had never bought a single mortgage bond before. A few months later, and more specifically after a 14% drop in US stock market and further weakening in the banking sector, the Fed announced a new round of bond buying, QE2. There has been an endless debate ever since as to who is actually benefiting from it. The most pronounced reaction came from Germany, when the German finance minister called the decision clueless. Today, 5 years after the initial launch, the numbers look grim. Experts outside the Fed suggest that the Fed might have created and spent over $4 trillion for a total return of as little as 0.25% of GDP. But the Fed has stopped questioning the wisdom of QE anyway. And it is exactly at this moment that the person who managed the initial launch of QE came out with an impressive confession and a profound apology. "I'm sorry, America," said Andrew Huszar. "We went on a bond buying spree that was supposed to help Main Street. Instead, it was a feast for Wall Street." It's not that we haven't suspected it anyway, but it does make a difference to hear it from the lips of the ex-Fed official who managed the program at its very beginning. What does that really mean for the US economy? Well, QE has been pumping money into the financial markets for the past 5 years, killing the urge for Washington to confront the real crisis, that of a structurally unsound economy. And as the country continues to be overly dependent on Wall Street to drive economic growth, isn't it rational to wonder whether we are in a bubble-like situation again?